If you are staring at your portfolio this morning wondering where 10% of your net worth went, stop. Do not sell a single share. Do not panic, sell blindly. There is a specific way to exit and a specific way to get slaughtered. OG Jhone AG here, on Friday the 13th. The algorithms didn't just break the market, they set a trap. While the S&P 500 and gold are being liquidated, there is one specific asset class that the smart money is quietly piling into right now, and it's actually up 40%, while the US burns. Most retail traders are about to panic sell the bottom. In the next 10 minutes, I'm going to show you why the crash is a lie, why the machines are hunting your stop losses, and the only trade that is safe for the weekend. Today is Friday, February 13th, 2026, and the markets are waking up to the aftermath of an absolute bloodbath that took place yesterday. We are talking about billions of dollars in market capitalization, evaporated in a matter of minutes, a flash crash that swept through precious metals, broke the back of the tech sector, and sent the VIX skyrocketing. If you thought the volatility was over, you are wrong. We are going to deconstruct exactly what happened minute by minute, why the algorithms turned against us, and why, shockingly, some parts of the global market are actually skyrocketing while the US burns. But before we tear into these charts, make sure you smash that subscribe button and ring the bell. Our analytics show that 60% of you watching right now haven't subscribed, and with the CPI data dropping today, you cannot afford to miss our next alert. Let's dive in. Let's start with the headline number that has everyone panicking. Gold did not just fall, it plunged into an air pocket. We witnessed a $163 drop in a single session. That is a 3.21% decline, settling at $4,921 per ounce. Just weeks ago, we were celebrating gold shattering the $5,500 psychological barrier, hitting all-time highs, and now we are fighting to hold the line at $4,900. But the damage in silver, it's catastrophic. Silver collapsed by $9. That is a 10.73% erasure of value in one day, closing at $75.22. We haven't seen an intraday destruction of wealth like this since January 29th. So, what actually triggered this? Was it a fundamental shift? Did the world suddenly decide gold is worthless? No, we have analyzed the order flow, and this has the fingerprints of a forced liquidation event written all over it. This wasn't human selling, this was the machines. Here's the timeline that proves it. The contagion didn't start in the metals pits. It started in Silicon Valley. At 9 a.m. EST yesterday, we saw the artificial intelligence sector begin to crack. Alphabet and Nvidia, the darlings of this bull market, started experiencing weakness right at the opening bell. Alphabet began sliding at 9 a.m., found a fake bottom at 10 a.m., and then the floor gave way. Precisely between 11 a.m. and 11:30 a.m. EST, we saw the contagion moment. The selling in AI broadened out to the S&P 500 and the Nasdaq, and that is exactly when the trapdoor opened for gold and silver. Bloomberg's macro strategist Michael Ball called it perfectly. This was systematic strategy selling. These are CTAs, commodity trading advisors, algorithms that chase momentum. When the AI sector hit a specific risk level, these bots auto-executed sell orders across everything to de-risk. They didn't sell gold because they hate gold. They sold gold because they had to cover margin calls in tech. It's a classic liquidity cascade. The damage to the broader indices is significant. The S&P 500 fell 1% to 6,870 points. Remember, we were above 7,000 in late January. That psychological 7K level is now a distant memory. The Nasdaq Composite took a harder hit, falling 1.5% to around 22,700 points, pulling back sharply from its record high of 24,000. And the Dow Jones, it gave back 1% to sit at 49,500, losing the critical 50,000 level it just conquered earlier this week. This is a technical breakdown. The S&P 500 is now trading below its 50-day moving average of 6,894. For the technical analyst watching, that is a massive red flag. We are currently sitting in a dangerous range. We have support at the lower Bollinger Band around 6,752, but if we break that, there is very little stopping us from a free fall. Upside resistance is now heavy at 6,980. And here is the most concerning indicator I am watching right now, the VIX, the fear gauge. Yesterday, the VIX spiked into the high teens and briefly cracked the 20 level, hitting 20.05. For those of you new to trading, a VIX above 20 is the line in the sand. It means protection costs are soaring and investors are paying a premium for put options because they are terrified of further downside. When the VIX is above 20, the intraday swings get wider, the algorithms get more aggressive, and the market becomes a dangerous place for retail traders. If we don't see the VIX close back below 18 today, you need to tighten your stop losses immediately. However, amidst this sea of red, there is a shocking anomaly that nobody is talking about. While the US markets are bleeding, emerging markets are absolutely ripping higher. Look at the IEMG ETF. It is up 44% year over year. While the S&P 500 is struggling, emerging markets have tripled the performance of the US index. We are seeing a massive rotation of capital. The Sell America trade is gaining traction. Investors are looking at the 6,800 level on the S&P and saying it's too expensive, and they are dumping that money into Brazil, Peru, and South Korea. The iShares MSCI South Korea ETF, EWY, and the Brazil ETF EWZ are leading this charge. This isn't just a weak dollar story. Although the dollar is down 10% year over year, this is a growth story. The BRICS trade is back, and IEMG is breaking out above multi-year resistance. If you are only holding US stocks, you are missing the only bull market left on the board right now. Technical analysis suggests IEMG has room to run to $98, which is massive upside from here. But let's bring it back to home base and talk about what happens today. Why is the market so jittery? It's all about the Federal Reserve and inflation. We are hours away from the January CPI release. Consensus estimates are calling for an annual increase of 2.5%. If that number comes in hotter than expected, say 2.6% or 2.7%, we could see yesterday's flash crash look like a warm-up. The market is currently pricing in 2 rate cuts for 2026, but a hot inflation print today will wipe those bets off the table. We had some mixed data leading up to this. Jobless claims fell to 227,000, which shows the labor market is still tight. That's bad for inflation. But continuing claims rose to 1.86 million, showing underlying weakness. It's a confusing picture, and markets hate confusion. Let's look at the technicals for gold, XAUSD, specifically for my precious metals investors. Despite the $163 drop, there is a glimmer of hope. The Relative Strength Index, RSI, is sitting at 44.72. This is neutral territory. We rebounded from oversold conditions. The MACD histogram is actually flipping positive, suggesting that underneath this panic selling, there is still some bullish momentum trying to form. We are seeing a battle at the $4,900 level. If we lose $4,900 decisively today, the next stop is $4,400. That is the hard truth. However, if the CPI data comes in cool, we could see a violent snapback rally toward $5,000. So here is your playbook for today, Friday the 13th. Number 1, watch the VIX. If it stays above 20, personally I am not buying the dip here. The risk is too high for my portfolio. The risk is too high. Number 2, watch the 10-year Treasury yield and the dollar index DXY immediately after the CPI print. If the dollar spikes, gold will crash further. Number 3, consider hedging. The algorithms are in control right now, and they are not trading on fundamentals, they are trading on liquidity pockets. The AI revolution that drove us to these highs is now the very thing causing the volatility. The systematic selling we saw yesterday in Nvidia and Alphabet is a warning shot. When the leaders stumble, the soldiers fall. But wait, because if you think the bleeding stops at gold and silver, you are missing the forest for the trees. We need to talk about the Magnificent Seven, because the reality check hitting the tech sector right now isn't just a correction, it is a structural dismantling of the trade that has held up the entire US economy for the last 3 years. Look at the data from Deutsche Bank. They are calling this a broad risk-off session, but that is Wall Street speak for get out while you can. The S&P 500 has logged its 3rd straight decline, but the real story is the rotation out of software and mega-cap tech. We have been warning you on this channel that the AI valuation bubble was stretching thin, and yesterday, it snapped. The algorithms didn't just target metals, they slaughtered the leaders. Nvidia, Alphabet, the generals of this market, showed weakness as early as 9 a.m., a full 2 hours before the rest of the market woke up to the danger. When the generals get shot, the army retreats. This is why the Nasdaq fell 2% and the S&P financials dropped nearly 2%, posting their worst performance since October. And here is the deep dive analysis that the mainstream media is glazing over. Why did financials tank? It's not just because stocks went down. It is because of the AI disruption ripple effect hitting commercial real estate. You see, as AI efficiency scales up, physical office footprint demand scales down. The market is finally pricing in the fact that these empty office towers aren't coming back. The logistics sector is getting hit too. We are seeing a widening sell-off that goes beyond just tech stocks. It is bleeding into the balance sheets of the banks that hold the loans on these empty buildings. If the KBW Bank Index is down over 3%, that tells you the smart money is terrified of a credit event. This isn't just a bad day for stocks. This is the market sniffing out a solvency issue in the banking system that we haven't seen since 2023. Now, let's pivot to the crypto markets, because the correlation here is terrifying. Bitcoin and Ethereum didn't act as a hedge yesterday. They acted like high beta tech stocks. The entire crypto complex crashed alongside the Nasdaq. And look at Coinbase. On earnings day of all days, we saw trading disruptions. When you need liquidity the most, the doors close. This is a massive warning alert for anyone holding assets on centralized exchanges. If the system buckles under standard selling pressure, what happens if we get a real black swan event? The digital gold narrative took a massive hit yesterday as crypto shed billions in market cap in lockstep with the legacy system. This tells us that institutional algorithms now treat Bitcoin exactly the same way they treat Nvidia, as a risk asset to be sold when the VIX spikes. But the most chilling reality check comes from the labor market data that slipped under the radar while everyone was staring at stock tickers. The Department of Labor reported that continuing claims rose to 1.862 million. Let me repeat that number. 1.862 million Americans are stuck on unemployment benefits. While the headline new claims number fell slightly to 227,000, the continuing number, the people who cannot find a new job, is rising. This highlights an underlying weakness in the labor market that has been prevalent for a year. The soft landing narrative is crumbling. If people can't find jobs, they can't spend money. If they can't spend money, corporate earnings collapse. And if earnings collapse, these stock valuations at 24,000 on the NASDAQ are pure fantasy. So, where is the safe haven? Ironically, it's the one thing everyone has been trying to kill, the US dollar. The dollar index, DXY, is floating above a 2-week low. Why? Because when the world gets scared, they rush into the most liquid asset on the planet, even if it is being debased. This dollar strength is the wrecking ball that is smashing gold and silver. The algorithm is simple: dollar up, gold down. It is a mechanical seesaw. And with the Fed potentially delaying rate cuts because of this sticky inflation we might see in today's CPI report, the dollar could rip higher, sending gold below that critical $4.900 support level we talked about. But here is the engaging twist that you need to pay attention to. While American tech stocks are burning, look at where the smart money is hiding. They aren't in cash. They are in emerging markets. We talked about IEMG earlier, but let's look at the value proposition. The S&P 500 is trading at historically high multiples. Emerging markets are trading at bargain basement prices. The Sell America trade isn't about hating America. It's about math. If the US dollar weakens over the next 12 months, which many macro strategists believe it must to service our debt, those emerging market assets explode in value. We are seeing a historic decoupling. Japan and Europe are stimulating. The euro area is increasing defense spending. These are tailwinds that the US market simply doesn't have right now. The US has headwinds: debt, inflation, and a tech bubble. The rest of the world has tailwinds: stimulus and growth. The capital rotation we saw yesterday, dumping Nvidia to buy Brazil, might be the defining trend of 2026. So, what is the final verdict for you, the retail investor, sitting at home on this Friday the 13th? You are standing on a knife's edge. Today's CPI report is the judge, jury, and executioner. If inflation comes in at 2.5% or lower, we might get a relief rally. The algorithms will buy back the tech stocks they dumped, gold will snap back to $5,000, and everyone will breathe a sigh of relief. But, and this is a massive but, if that number is 2.6% or higher, the market will reprice for 0 rate cuts in 2026. That means the 10-year yield spikes, the housing market freezes, and the flash crash we saw yesterday becomes a full-blown bear market trend. You need to be watching the real numbers, not the headlines. Watch the VIX, watch the 10-year yield, and watch the $4,900 level on gold. If that breaks, don't try to be a hero. Cash is a position. Patience is a strategy. The market transfers wealth from the impatient to the patient. Yesterday, the impatient got liquidated. Today, the patient are watching and waiting. If you think yesterday's 3% drop in gold and the 2% slice off the NASDAQ was just a glitch, you are not paying attention to the plumbing of the entire financial system. What we witnessed yesterday wasn't just selling, it was a liquidity evaporation event driven by what we call zero DTEs, 0 days to expiration options. Look at this chart. This is the volume of options that expire within 24 hours. In 2024, this was 40% of the market. Today, in 2026, it is over 60%. Why does this matter? Because market makers, the institutions that are supposed to keep prices stable, are being forced to hedge these massive short-term bets instantly. When the AI sector started to wobble yesterday morning, billions of dollars in call options became worthless in minutes. The market makers, who had bought stocks to hedge those calls, suddenly had to dump that stock. Instantly. This creates a feedback loop from hell. The selling begets more selling. The volatility spikes, the VIX jumps, and the algorithms pull their bids. This is why the market feels so fragile. There is no depth. There is no cushion. It's just machines trading against machines, and when the music stops, the retail investor you is left holding the bag. Now, let's get real. Let's step away from the flashing tickers and look at the Main Street reality check that Wall Street is terrified of. The soft landing narrative relies on one thing: the US consumer. But look at the delinquency data we just pulled. Credit card delinquencies have just hit a 15-year high. Auto loan defaults are ticking up in the subprime bracket. The reality is that the average American has burned through their pandemic savings. They have maxed out their credit cards, and now with inflation proving sticky at 2.5%, their purchasing power is gone. The stock market has been rallying on the idea that earnings will grow, but how can earnings grow if the customer is broke? This disconnect is what we call the valuation gap. The S&P 500 is priced for perfection, priced for a consumer with infinite money. Yesterday's sell-off was the first time in months that the market looked at the consumer data and blinked. If the consumer stops spending, the AI revolution doesn't matter, because nobody will be buying the software. And we have to look east. We have to talk about Japan. The carry trade is the ghost in the machine. For years, investors borrowed cheap money in yen to buy expensive US tech stocks. But the Bank of Japan is waking up. We are seeing signals that they are preparing to tighten policy again to defend the yen. If the yen strengthens even by 1 or 2%, billions of dollars in that carry trade have to be unwound. That means selling US stocks to pay back Japanese loans. We saw a flicker of this yesterday. The correlation between the yen strengthening and the Nasdaq falling was almost 1-to-1. This is a global margin call waiting to happen. If you are only watching the S&P 500, you are watching the scoreboard while the stadium is burning down. Watch the USD-JPY pair. If it crashes below 140, the US equity market will not be able to hold these levels. Now, let's look at the bond market, the smart money. The 10-year Treasury yield is sniffing out something the stock market missed. It's starting to creep back up. Why? Because the bond vigilantes are worried that the Fed has lost control. If inflation is sticking at 2.5% or higher, the Fed cannot cut rates aggressively. They are trapped. If they cut rates to save the banks, inflation explodes. If they keep rates high to fight inflation, the commercial real estate sector and the regional banks holding those loans implodes. This is the Fed's dilemma. And yesterday, the market realized there is no easy way out. Sentiment is shifting fast. The CNN Fear and Greed Index was in extreme greed just last week. Yesterday, it dropped like a rock into neutral, bordering on fear. This psychological shift is dangerous because it changes behavior. In greed mode, bad news is bought. In fear mode, good news is sold. If today's CPI number comes in exactly as expected, 2.5%, do not be surprised if the market still sells off. Why? Because good news is no longer enough to justify these valuations. We need spectacular news to keep this bubble inflated, and we just aren't getting it. So, what is the strategy for the weekend? For my silver bulls, the drop to $75 is painful. I know, a 10% haircut in one day is brutal. But look at the physical premiums. While the paper price crashed, the premiums on physical coins and bars actually ticked up yesterday. Dealers are not lowering their prices because they know the paper price is fake. This is a disconnect between the casino market and the real market. If you are a long-term holder, this is noise. If you are a trader, you got stopped out. Re-entry requires patience. Wait for a close back above $80 before you touch it again. For my stock traders, stay small. The volatility is not over. The Friday flush is a real phenomenon where traders dump positions before the weekend so they don't have to worry about headline risk on Saturday and Sunday. If we break the 6,800 level on the S&P 500 today, we could see an accelerated sell-off into the close. We are entering the survival phase of this cycle. The easy money of 2025 is gone. The winners of 2026 won't be the ones chasing Nvidia. It will be the ones who respect the VIX and spot the rotation into emerging markets. Do not navigate this volatility alone. Check your subscription status right now. The algorithm suppresses bearish news, so ring that bell to ensure you get the alert when we go live for the CPI print. Question of the day. Are you buying the dip in gold at $4,921, or are you waiting for $4,500? Let me know in the comments. Stay liquid, stay alert, and I'll see you in the next update.